Hello and welcome. Today, we are pulling back the curtain on the hotel industry. If you've ever looked at one of those big, beautiful hotels and wondered, how does this actually work as a business? How do investors figure out if it's a good bet? Well, you are in exactly the right place. We're going to build a full on checklist of the key numbers you need to understand.
All right, let's kick things off with this quote because it really gets to the heart of it all. We think we're buying a room, a bed for the night, but what we're really buying is an experience, an aspiration. For a lot of people, being able to afford that experience, well, that's a matter of pride. But that creates a huge question for an investor, right? How on earth do you put a number on a feeling?
So, here's how we're going to tackle that. This is our game plan. First, we'll dig a little deeper into this idea of selling an experience. Then we'll start building out our performance checklist. After that, we'll get into the nitty-gritty of measuring popularity and price, and then look at how hotels make money beyond the room. We'll also figure out how to make fair profit comparisons, and then we'll wrap it all up with the key takeaways you need.
So, what exactly is this aspirational value? Think about it like this. Picture the most famous luxury hotel brands out there. You know their names, even if you've never set foot inside one. That name it means something. It's a place someone might save up for to celebrate a huge life moment. That brand, that feeling they create, that's their secret sauce. It's their most powerful asset, even though you can't see it on a balance sheet. But as investors, we can't just invest in a vibe. We need to see how that vibe translates into value, into actual measurable results. And that is exactly where our performance checklist comes in. Think of it as our toolkit for turning that fuzzy feeling of a brand into cold, hard numbers we can analyze.
Which, of course, brings us right to the million-dollar question. How do we do it? How do we take something as abstract as an experience and pin it down with data? Well, the answer lies in a handful of very specific metrics, or KPIs, that are tailor-made for the hotel world. So let's start with the absolute basics.
First things first, we need to understand a hotel's size and scale. We look at two things. First, the number of properties. This tells you about their geographic footprint. Are they spread out all over? That can be a good thing because it protects them if one region has a slowdown. Then we look at the number of keys, which is just industry speak for rooms. Lots of keys means you can host huge weddings or conferences. But it's a double-edged sword, because every single one of those rooms represents a fixed cost you have to cover day in and day out.
Okay, now we're getting to the really good stuff. This is the heart of it all. There is a trio of metrics, a holy trinity, if you will, that every single hotel investor is obsessed with. Together, they tell us exactly how popular a hotel is and how much power it has to charge what it wants.
The first one is the occupancy rate. It's super simple, really. It just asks, what percentage of your rooms did you actually sell? It's the most direct way to measure demand. It's kind of like a popularity contest for hotels. If that number is high and climbing, that's a fantastic sign that the brand is strong and people want to be there.
So, how do they actually calculate that number? Well, it's pretty logical when you break it down. You start with the absolute maximum number of rooms you could possibly sell. That's just your total rooms times 365 days a year. But of course, some rooms might be out of service for repairs or whatever, so you subtract those to get the real number of available rooms. And the last step is easy. Just divide the rooms you actually sold by that available number. Simple, right? But so powerful.
All right, next up in our trio is the average daily rate, or ADR. Now, this one answers a different question. On average, for every room you did sell, how much money did you make? You just take your total revenue from rooms and divide it by the number of rooms you sold. ADR is all about pricing power.
Okay, let's look at this table because this is where the story gets really interesting. See that base case? The ADR is 6,300. Now look at scenario 1. The total revenue is exactly the same, but look, they had to sell 50,000 more rooms to make that money. What does that tell you? It tells you they had to slash prices. They ran a sale, basically, and that dragged their average rate way down.
Now, scenario 2 is even more sneaky. At first glance, you might think, hey, revenue went up. That's great. But hold on, look closer. The number of rooms they sold went up even faster than the revenue did. And the result? The ADR still went down. If you see this happening quarter after quarter, it can be a red flag that the brand is losing its premium shine and has to fight on price.
And finally, we get to scenario 3. Now, this is what investors love to see. Revenue shot up even though they actually sold fewer rooms. Wow, that is fantastic. It means they had the power to charge a lot more for each room, and people were willing to pay it. The ADR just skyrockets. This is the clearest sign of a powerful brand with serious pricing power.
This brings us to the third and maybe the most powerful metric of them all, revenue per available room, or RevPAR. Now here's the key difference. Unlike ADR, which only looks at the rooms you sold, RevPAR looks at every single available room you have, whether it was full or empty. This gives you the most complete picture of how good a hotel is at turning its physical space into money. So let's make sure this distinction is crystal clear. ADR tells you the price you got for the rooms you filled. RevPAR tells you how you performed across your entire building. It's the ultimate combination metric because it's driven by both how full your hotel is, your occupancy, and how much you're charging, your ADR. A rising RevPAR is, without a doubt, the gold standard for hotel performance.
But wait, there's more. The best hotels know that the money-making doesn't stop when someone checks in. A huge part of the experience happens outside the room. So as a smart investor, you've got to look at the whole revenue picture, not just the room rentals. And this chart shows you why. You might think room revenue is the whole story, but look at this. In a typical hotel, it's maybe 60%. The other 40%, a huge chunk, comes from food and drinks, the spa, and other services. When you see a healthy mix like this, it's a great sign. It means guests aren't just sleeping there, they're living there. They're dining, they're relaxing, they're spending money across the entire property. Okay, let's get into a slightly more advanced topic, but it's one you absolutely have to understand. How in the world do you compare the profits of two different hotel companies when their business models are totally different? I mean, one company might own all its buildings, and another might just manage hotels for other people. Here's why that's a problem. Company A, the one that owns its buildings, is going to have huge expenses for things like depreciation on the building and interest on its loans. That makes its final net profit look smaller. Meanwhile, Company B, the asset-light manager, doesn't have those costs, so its net profit looks way higher. Just comparing them side by side is completely misleading. It's not apples to apples at all. So what's the solution? It's a fantastic little metric called EBITDA. That stands for earnings before interest, taxes, depreciation, and amortization. Basically, it strips out all of that financial and accounting noise and just shows you the raw earning power of the hotel's actual operations. It levels the playing field and lets you make a real, fair comparison between any two companies, no matter how they're structured. Phew, we have covered a ton of ground. So let's bring it all home and boil it down into one final, easy-to-use checklist that you can take with you to analyze any hotel company out there. So here it is, your final checklist. First, check the number of properties and keys to understand their size. Next, look at the occupancy rate to see how popular they are. Then, dig into the ADR to see if they have pricing power. Combine those two into RevPAR to get the ultimate performance snapshot. After that, check the revenue mix to see if they're selling the whole experience. And finally, always use EBITDA to make a fair comparison of their profitability. And that is our deep dive into the investor's checklist for the hotel industry. I'll leave you with one final question to chew on. As the economy goes up and down, which one of these metrics do you think is the single most important signal of a hotel's true strength and its ability to weather any storm? Thanks so much for joining us today.